Allow me to introduce our next speaker, Bob Robotti. He is the President and Chief Investment Officer at Robotti & Company, a New York-based asset management firm with a deep value focus. It was founded in 1983. Bob holds a bachelor's degree from Bucknell University and an MBA from Pace University, and currently serves on the board of directors of 3 publicly traded companies, AmRep Corp, Tidewater, and Pulse Seismic. At a time when many investors are narrowing their field of play or just investing passively, Bob will speak today about the opportunities in good old-fashioned, bottom-up, fundamental research on individual companies with highly compelling valuations. Please join me in welcoming Bob Robotti.
Thank you all. Thank you, John. Thank you, CT. Thank you, everyone, for your Southern hospitality. I appreciate it very much. So, a classic value investor. One of the perennial problems that we have is buying too soon or buying companies that get classified as value traps. What I really want to talk about today is the opportunity to stay through those companies, understand the opportunities, and see that value trap unchained and identifying that and then putting capital to work. So as I said, there's a single focus in what we do. It's Ben Graham valuation concepts. We think that, buying things with margins of safety and valuation matters. It's a critical thing. It's a repeated concept you've heard today. The firm itself, we manage money in separate accounts. We have a number of private partnerships. Curtis Jensen has been with us for almost 10 years. Titus Schwartz for 20 years. So therefore, a commonality that is there. The 4 decades, what we've done is, more than anything, we've also accumulated people who have a passion for picking stocks. And that environment is critical to the work we do. The business model I have has both a broker-dealer and an investment advisor. The broker-dealer talks to like-minded investors where we share investment ideas. And, of course, the asset management businesses, we employ capital, put it to work. And, of course, that's 50 years ago when I got out of college. I started to audit Tweedy Brown and then work for Mario Gabelli. So that's their business model. And, of course, I do what everybody does. You copy people that you know that are extremely successful, and you do the same thing. The focus we have is definitely on small cap, mid cap equities. And of course, that's the largest universe in the U.S. of public companies. And therefore, by doing bottom up fundamental research, we think we can identify extremely compelling investments. As it's mentioned, I'm on the board of a number of companies. If we're looking at beaten up and out of favor companies, the advantage of that is you have the opportunities to talk to the principals, the managements, the boards, the other shareholders, because no one else is talking to these companies, because no one else is interested in the companies. So therefore, you're not fighting to get time with the people who can tell you something about it. As part of that process, we develop relationships. And currently, I sit on the boards of 3 of the investee companies we have. We're in it for a long time to be able to have a seat at the table in terms of the selection of senior management and the allocation of capital. We think are critical advantages we get, and the offsets we have, we think are well worth all the cost. Jim Grant is known as saying that in science and engineering, progress is cumulative. In finance, it's cyclical. That's extremely interesting. And understanding and appreciating cycles, we believe, is a critical thing that many people do not have today or have forgotten about. And of course, one of the key things that's happened is not long after I graduated college in 1982, the 10-year treasury has gone from 15% to went to just about nothing. And that's a 40-year trend that has huge impacts on the allocation of capital. And we think capital is still largely allocated based on that and under other economic fundamentals that we think are not permanent, that are cyclical, that do change, and therefore mean you have to reallocate capital. Clearly, one of the beneficiaries of that is private capital. Private capital today is a vastly different thing it was than the 10 years after it became popular after I graduated college, which was you found the company trading in the public markets for far less than what it was worth. Very smart people took control of that company, levered it up, and then took the parts apart and therefore realized the value and made a lot of money. And they did it to get returns. Today, it's an asset accumulation business that's all predicated on getting 2% of assets for the money under management, having it tied up for 10 years, creating a 10-year annuity, and not about generating returns. And of course, it's got to be how to trade. So the amount of capital is there. So we think that over the next number of years, there's plenty of places that capital has been allocated today that have huge hurdles, at least on generating returns in front of it, and probably some risk in terms of what are you paying and what are you getting. In addition to the allocation of capital predicated on historical movements, which we don't think are permanent, is also the flow of capital and how it works. The comment was made earlier today that the marginal buyer and seller of stock is not someone doing fundamental bottom-up stock research, but there's something else that's setting price. And of course, that's the most important transaction because it's the price-setting mechanism. Prices are set by someone who's not doing fundamental research. Therefore, we think a huge opportunity for you all doing bottom-up fundamental research because we think the next 10 years, stock pickers are going to significantly outperform. And if you think about it intuitively, it's something people have probably said for 5, 10 years. And therefore, because it hasn't happened, doesn't mean it won't happen. It means it's more likely to happen, I would suggest to you. So what do? Right? We think small cap, micro cap is always what we've done. And we think, of course, that universe is large, and we think that's where the opportunity is. And of course, today, one of the things with the index is people say it's a bad index because there's 1,000 companies in the Russell that don't make money. So we think the opportunity, of course, is really in doing research on the zombie 1,000. So those companies that have been given up for dead, that, if you go through and do bottom-up research, we think you can find extremely compelling companies. So what we're looking for when we look through that garbage heap is we're looking for businesses that we can understand, we can appreciate the dynamics, we can buy a business for a fraction of what it would cost to build that business because nobody in their right mind would want to build a business because it's not making any money. If it's not making any money, why would you build it? But of course, that process means something goes on. The industry downsizes, right sizes, consolidates. So it adjusts to that process. In the meantime, the public price of that stock continues to dwindle. So therefore, the price you pay goes less. The business cathartically is improving in that process. We will also observe from our experience, the longer it stays bad, the better the opportunity is because there's more downsizing, there's more consolidation, there's more opportunities to deploy capital at the bottom of a cycle to increase the earnings power. So we want it to stay longer. It hurts your performance in the short term, but it improves the return that you'll get on that investment. And again, we're looking for businesses that we think have really long runways. And that is because how long the business has been bad and how difficult it's been, we think there's a significant opportunity. So that's what happens. Not only do you have a cyclical recovery, but if it stayed bad, there's been more consolidation, and we can identify the right companies. That's what it is, right? We're not looking to buy $1 for 50 cents. We're looking to buy $1 for a third of what it's worth, a quarter of what it's worth, a fraction of what it's worth. But most importantly in that process, we're also looking for a company that not only are we buying that dollar cheaply, that we can identify paths for that dollar to be worth $2, $4, $10. So fundamentally, we are not value investors. We are growth investors buying cheap companies as an entry point. So therefore, and if you look at Cap IQ and you look at their classification based on statistical information, it calls me a growth investor because that's what we're looking for. So here's the company I want to talk to you about is a company called 5 Point. It's a real estate company. Real estate companies, land development are great companies to be value traps, right? Because what is it? You own phenomenal assets. And people say, ooh, look at that asset. That's a great asset. It's worth a lot more money. And it's true. It's worth a lot more money. However, the value of any business in the stock at which it trades is predicated on the cash flows it generates. It's not based on the asset value. And if asset values aren't generating cash, people don't know how to value assets. And if they don't know how to value assets and things are bad, they get discounted. So the opportunity gets larger. So here you have a company that has four main assets. One, developable land in Orange County. 2, developable land in Los Angeles County. 3, 2 pieces of land in San Francisco, greater San Francisco. So places in which housing shortages have been rampant forever. So therefore, what they own is an extremely scarce resource. So these are extremely valuable assets. But what the hell are they worth? And why is it a value trap? So here's the financials. So there's where it's a value trap. As I said, look at the bottom line. Burn $58 million in cash, burn $346 million in cash, burn $248 million in cash, burn $81 million in cash, burn $82 million in cash, burn $181 million in cash, and you go from $185 million in net cash to $560 million of net debt. You burn $750 million, $5 a share. Obviously, that stock starts at 14 with a $2 billion market cap and enterprise value and ends up at $2 with a $300 million market cap and $600 million in debt, so a $900 million enterprise value business. Now, what happens? Value trap unchained. Then suddenly, 2 years ago, something starts to happen. It generates 154 million. It generates 115 million. Suddenly, the debt goes from 568 million in net debt to 157 million in net debt. This thing is generating huge amounts of cash. So this business has reached an inflection point. What happened? So that's it. There are three strategic assets that are here. That real estate, and that real estate is in California, acquired opportunistically by Lennar, like one of the major home builders, and acquired in post the housing crisis. So when people were getting rid of land because they just couldn't sell it, were discounting it, they stepped in and acquired these pieces of land extremely opportunistically at extremely discounted prices at the bottom of the cycle. So these are valuable assets. There are 30,000 home sites that they can build on this land. The problem is the management team had too much cost, and developing assets means you put cash in up front, and therefore you're not generating cash. So therefore, again, losing cash, I don't know what it's worth. In the meantime, what happened here was 2.5 years ago, a new management team came in, reduced the overhead cost in half, the assets then also started to realize value, and that's what it is today. The Orange County project, which is the smallest of their Project Great Park, and the one furthest along in development, probably will generate in the next 4 to 5 years cash flows equal to the enterprise value of the business. So therefore, and then in addition, the two much more valuable assets are ones that are also in the stage gestating and generating significant cash. So you can figure the value, and those are worth multiples of what this one is worth. In the meantime, it's interesting to think, people talk about enterprise value. Enterprise value today is $1 billion. Enterprise value when it had 568 million in debt and 300 million market cap was $1 billion. So the enterprise value of this business is the same thing as what it was 2 years ago. Even the stock price is more than doubled over that period of time. So what happened? Part of the thing important is Lennar is the largest shareholder here. They own 35% of the company, 39% of the company. They control the board. And therefore, what they did was they said, I got to get new management in here. I got to do something different with this business. So you have the best of all worlds. You have an activist. The activist is the controlled shareholder. So therefore, you didn't have to try to do that. You couldn't get Lennar out, right? So they're in a protected position. But the controlled shareholder decided to do something. And that is Lennar was looking at their total portfolio and the non-home building part of it to do different things, including they're currently spinning off from Lennar a REIT, which is a lot of the land development businesses. So Lennar did something. In addition, the assets were reaching a certain stage of cumulative generation from converting from asset value to cash flows. And then what also happens is that cash flow means with almost just about 100 million in net debt, they clearly have an opportunity to refinance the business today. They have a very different cost of capital. Therefore, they have flexibility to do something with the cash, including right now they're restricted from paying a dividend or buying back stock. But if they refinance the debt, they'll be in a position to buy back stock. So a potential another avenue of creating value is purchasing stock. And so one of the things that I'm on the board of is AMREP. So it's a much tiny little company. It's land development business. And when I went to the board in 2016, we had 8 million shares outstanding. And they've done a whole bunch of things to realize and convert the assets into cash and cash flows and generate a lot of money. And in the process, we've also gone from 8 million shares outstanding to 5 million shares outstanding. So therefore, we've almost reduced the share count in half. So the value increment added by buying back stock far below what the assets are worth. And here's a situation where you know what the assets are worth, or you have ideas and you know it's a multiple of where it's trading at. And therefore, that opportunity is a clear and obvious one. And what are these assets worth? That one's, I don't know the answer to that, but I know that the margin between what they're trading at and where their value is I don't know what the multiple is. I don't know if it's 3. I don't know if it's 4. And importantly, who are the people and how's the cash going to be reallocated to potentially generate incremental value, including are there opportunities, A, to redeploy the capital, B, to buy back stock? Are there other things to be done here? And I think there definitely are. In addition, not only do you have the control shareholder doing something, but what you also have is, so in September, that's what it was. We followed this company for a long time. So John Moran is a guy who's about 60 years old. He's been doing real estate for 30 years. He's been with me for 10 years. In 2019, we went out to California. We visited the properties and looked at this thing. The problem was it's losing cash, burning money. We're like, it's premature. However, we saw that the inflection had happened in the business, and therefore gave us the opportunity. So in September, there was a shareholder. So actually, go back here. So there's the stock chart. So there's what you see is a value trap. So Luxor was a private fund. In 2019, accumulated 20% of the company. So therefore, they owned it. So what happens is, if you are going to own something that is a value trap, you have to have the staying power to understand and to be able to stay through to the conversion of assets into cash flows. In the meantime, he didn't have that staying power. So therefore, he bought in at 6 and 5 and sold out at 2 and was leaning on the stock forever. We were able to purchase in the open market 10% of the company. So that was the entry point that we had after the results had turned. The market hadn't adjusted because he's leaning on the stock, selling the stock repeatedly, and filing every time he has to file. So it was a huge opportunity. But what then happened was, a week after we bought that 10%, another guy bought 17% of the company from another control shareholder who was on the board. So Castlegate was a company that was a distressed investor who was a partner in the purchase. A partner in the purchase of the San Francisco property back in 2010, who was looking for an exit, which is part of the reason why this company went public, was to give them an exit, but it was premature. There was no exit. And that happens a lot with value companies and distress and insiders and smart people. They want to get out of the business. They can't get out of the business. They IPO the business and there's no market. And what they do is they then trash the public stock and therefore ruin their ability for an exit, but give huge opportunities for someone who's watching that opportunity, seeing that there's a shareholder who wants out. And then not only did that guy want out, when he sits in the boardroom, he's thinking, how do I monetize my investment? How do I monetize my investment? When he sells his 17% to this new investor, he's suddenly thinking, how do I create value? Importantly, also, Lennar is the control shareholder. Lennar is also one of the largest customers. So there's a concern about where's their loyalty lie? What's the economic value? When they sell land out of 5.2 Lennar, what's the right value for that? Now I suddenly have 17% of stock owned by somebody who sits on the board who's an extremely knowledgeable real estate investor. So their family was critical in giving Paul Reichman the money to buy Canary Wharf out of bankruptcy. So this guy has tremendous experience in real estate investing in a distressed situation, and also in 2009 bought land in Valencia, that's the LA asset, and developed it over a number of years and made 2 to 3 times his money. So this guy is aligned with us, and I didn't know I was going to get that. I had a concern how Lennar would think about this business and what would that mean for me. Now I suddenly have someone owning 17% of the company, sitting in the boardroom, extremely knowledgeable about how to reinvest that capital or to return that capital as an extra beneficiary that came from this investment. And that's it.
Hey, thank you. You said the kind of the quality of valuations have kind of gone down in recent years. So, you said kind of the quality of valuations has gone down in recent years, and you can kind of find value through companies that are complex to value. So, kind of, I guess, how do you go about accurately doing that?
The way you accurately go about that, you look at these assets here, and the advantage is the value of these assets is so much greater than the public trading price of the stock. Excel spreadsheet that comes up with the numbers. These assets really are worth 4 or 5 times easily what they're on the balance sheet for. And there's a lot of metrics that you could use to come up with those valuations. And so therefore, coming up with things that don't generate cash. So for example, like there's a lot of examples like that. That you're buying it at such a big discount. You don't know exactly the multiple, but that's not the issue. And of course, the other thing is, as I said, the longer it takes to happen, frequently, the more the asset tends to be worth because more things happen. For example, in this situation, land in Orange County in their Great Park, in 2019, when we visited with them, we didn't want to own it because they were burning cash. Land sold for $4.5 million an acre. Land's now selling for $9 million an acre. So the asset is one in which it is in short supply, high demand. It's an inflation protector because the value of it more than exceeds what you didn't get in terms of timing. So the asset value was growing while you waited for it to be able to be manifested.
Thanks, Bob. So Django referenced earlier with investors kind of overshooting or undershooting the capital cycle. I'm kind of curious in your experience being on some boards, how you kind of ensure management doesn't overshoot those cycles themselves and kind of drink the Kool-Aid at the peak.
The problem with the boards I sit on is I'm the one who drinks the Kool-Aid. So, so Pulse Seismic I've been on the board of for a bunch of years, and the stock's done nothing. It's been a dismal disappointment, and I spend a lot of my time actually encouraging management and the rest of the board to say, no, we have an asset that is valued in the market at $120 million Canadian, so that's only $80 million in real money, and in spite of the fact that that asset to replace would cost over $2 billion and would take years to do. And you'd have to go into Canada, cut down trees, explode dynamite, and take seismic readings, which you're just not going to do. So therefore, the asset we have is an irreplaceable asset. And that asset is one in which every oil and gas company in Canada has to have the data. It is a small cost and yet gives information as to where to drill, how to drill. So the value of the data is a multiple of what we license that data for. The fact of the matter is Canada has been a place that's had total outflows, reductions, scale backs for the last 10 years, and prices have gotten weak. In that environment, it's tough to do well, except in that environment, we consolidated two other competitors. So today we're the largest company in the business. So we've grown that business and paid off all the debt we took on from buying those businesses, and we took on debt. We didn't issue stock. So therefore, the per share number, and in the meantime, we buy back stock. So therefore, I have spent a lot of time encouraging the rest of the board and management to, it hasn't worked, but this asset is worth multiples of where it trades. And the key, though, it will not do that until I'm right, that in the next 3 to 5 years, activity in Canada is dramatically higher, drilling is more, and more transactions happen, that oil and gas companies get bought. Because what happens is the data is licensed by the company, and when they sell, the new guy has to relicense the data. So the quantity of data to be relicensed in the next 5 years, in my mind, is a multiple of where it has been. And the pricing will have pricing power at the same time. And I think this generates huge amounts of free cash flow. Will it? I could be wrong. But I have that's right.
Okay, we have time for one more. Jared, I think has.
Hi, Bob. On your highest conviction ideas, it kind of seems that you have like an outsized position as far as like a percent of the common shares outstanding. So how do you view liquidity or exiting a position when you are maybe 10% of the shares outstanding?
It could. It probably shouldn't be a problem. So here's what I said. So Tidewater is something, right? I own a lot of stock. I own 6% and 7% of the company. I sit on the board. And what happened, of course, last year was people suddenly, supply demand for the assets came into balance. And instead of trading at 20 cents in a dollar, suddenly that supply demand meant that pricing power happened, free cash flow happened. And suddenly this went from business that didn't generate any cash to generating a lot of cash with identifiable future cash flows growing. So the stock dramatically improved. So the stock goes from 20 to over 100. So therefore, it did give me the opportunity to sell some stock. Now, I also believe that the business, the cash flows, and the assets are worth substantially more than that. But it did give me the opportunity. And when that's happening, suddenly the volume and the activity that flows into the stock, because the way the world works today, like all the activity, there was a lot of momentum that purchased that stock. It shouldn't have gone over $100, right? It should have stopped someplace around $80. But that momentum happened. People want to be in it. It got added to an index. Suddenly you had to buy 6 million shares of a company with 52 million shares outstanding. So there's going to be a lot of buying activity that happens. So if there's an opportunity at some time when it does get the price to value that I do think makes more sense, I actually think that I won't have a problem with my exit. And if I take some discount on it, I still, in the aggregate, should do well in that process. So.
Okay. All right, Bob, thank you very much.